G'day, ladies and gentlemen. Welcome to another episode of Expat Chat, episode 21. I'm joined by the Managing Director of EMEA, Brett Evans of Atlas Wealth Management and Atlas Wealth Management, DIFC, I should say as well. I'm James Ridley, Managing Director for APAC Division here in Australia. How are you going, Brett?
Hey, well, it's what's today? It's a Tuesday, and sun still rises in the east and sets in the west, and we're getting on with life.
That's right. How's the daily active cases over in the UAE at the moment? Is it coming down or?
Look, it's hard to say. We're sitting around the 200-300s, then we spiking up into the 700s, then back down to 400s, and back up to 700s, 500s, 700s, 400s. I think it has a lot to do with resumption of school. If you had travel within 14 days of returning to school, you had to get tested. So we're always going to get a lot of people, that testing numbers, testing numbers are about 80,000 a day. So there are a lot. Keeping an eye on the positivity rate, making sure that it doesn't spike too high. But it's amazing to think that the last time that the UAE went into lockdown was about this level in terms of numbers. Yeah. But now it's just coping with the numbers. So I don't think we'll go to lockdown if we sustain these numbers. But at the same token, if we do see a spike, then I hope for my daughter's sake they don't go back into distance learning. They're loving me back at school, even though it's very different. Who would have thought that masks would be part of the school uniform list? But it is, and honestly, they don't care. They're just like, okay, it is what it is. Let's get on with it. They'd rather be there than sitting at home. So I think we just take that. Parents can worry too much about their kids sometimes. At the end of the day, kids are pretty resilient, and if that's in their best interest, then off they go.
Yeah, well, let's hope things just keep improving then. I mean, I know back in Australia, where we are, the headquarters, Queensland, we're obviously doing really, really well. I can't really make a comparison there, but Victoria, I think yesterday recorded its second lowest sort of new case for months. So that's a good sign. Things are coming down in Victoria, and we'll wait and see what happens there. I know the Premier, he sort of applied for some special powers around trying to keep Victoria in lockdown for up to 12 months. It's ridiculous. I'd hate to think what that would do to the local economy and especially our GDP. As we know, Victoria, they make up 25% of that. So we'll wait and see what happens over the coming months, especially now that we're heading for budget territory as well, October. That's exciting.
6th of October. It's going to be interesting. It's already starting to see some dialogue coming out from the press regarding what may or may not be in that budget. Tax reform is on the charge. There's all these sort of conversations. So it's certainly been generating a lot of conversations in expat land in terms of, will those tax changes be positive or negative for expats? So we'll be running webinars, live webinars like we have in the past, after that budget, just to inform expats, okay, rightio, this is what you need to be aware of. So just for everyone, keep an eye out on our social media channels. We're on Facebook, LinkedIn, Twitter and Instagram. So you can follow us at Atlas Wealth Management on any one of those channels. We'll obviously put links to those social media channels in the show notes below.
That budget, I can't see it being an aggressive budget, given we have another one coming out in May. Surely it's going to just be a transitional soft budget. I mean, what can they really do?
It's going to have to be along the lines of building confidence and trying to get the consumer to engage, trying to get businesses to engage. The numbers coming out over the last couple of months have shown that the consumers have pulled their heads in when it comes to their spending capacity. So
you're right.
It's all well and good for money to be flowing, but if it's not hitting the tills, then we may have a big problem on our hands.
Yeah, that's right. I think a lot of personal debt levels have come down, but household debt still stays similar, but people are paying off their credit cards, they're paying off their loans or those sort of things, but mortgages are still staying pretty on par. Before we go into it, Brad, actually, you might want to just look at doing that disclaimer before we delve further.
All information that you have the pleasure of listening to and watching is for educational and entertainment purposes only, should not be construed as personal financial advice.
Yeah, that's right. But yeah, I mean, you're right. The biggest issue is it's not hitting Main Street, as we put it. It's not hitting obviously retail at the moment. Most people are pretty conservative with their spending habits, so I think they're just going to have to be somewhat maybe aggressive in tax reform, so more money's in the pocket, but getting people spending as well. Somehow incentivizing it in other ways.
Look, I think people know that there is that often used phrase fiscal cliff coming up, and that's going
right.
to be the big litmus test as to how the Australian economy is going. As soon as you remove JobKeeper, as soon as you remove repayment holidays, as soon as you remove rental eviction moratoriums,
Yep.
we'll see when the water goes out, see who's wearing pants. And, for the first time, like we said in our recent webinar, for the first time in my career, which scary enough gets up to now 24, 25 years, I've never seen one, let alone two bank CEOs say that people should start selling their property if you can't afford to make those payments. Banks aren't in the business of telling people to not borrow. And I think what that does is it gives you an incredible insight as to what they're seeing, because everyone loves flashy banking apps and internet banking. But what they don't realise in the background is quite a high amount of AI, artificial intelligence, that enables them to predict and monitor how their customers are going in terms of their payment of bills and all those sort of things.
Habits.
So they would see, how many of their clients' income and their salaries have reduced. That all their technology would tell them this. And for bank CEOs to come out and say these things, to me, says that they're seeing what they're seeing in the background in people's private lives, in inverted commas, isn't the best.
Yeah, absolutely. I mean, I think when you refer to the CEOs, it was, what was it, NAB and CBA. NAB said worst case scenario, property's coming back up to 30% over the next 3 years, which is a scary figure. And then the CBA was saying people should consider taking equity now, because in 6 to 12 months, that equity is not going to exist, which again, that's obviously on par with when we might see this fiscal cliff. They roll back all the stimulus packages, small businesses struggle. If there's a second wave, they'll have to keep printing money and restart.
And Shane Elliott, the ANZ CEO, came out, was it 2 days ago? Late last week, saying they're looking at on average 15% falls. And he also reiterated too that serviceability is a concern. So that's 3 CEOs coming out saying they're worried. And we're not talking about, we haven't got through it yet. We haven't even started yet, which is what they're implying.
That's right. Yeah, we haven't seen the fiscal cliff. I mean, there was talks of that it might be a bit more of a fiscal slope, but again, we just won't know. I think most of the packages will keep going out until the end of the calendar year, and then probably obviously be revised when we enter the new year, just to see where we are, especially with COVID cases, those sort of things. Borders still shut.
Yeah. Look, it's going to be something that I think in our book, the longer that we see situations like Victoria drag out, the worse the damage is going to be. So, every 2 weeks that Mr. David Andrews extends, the property industry, especially in Victoria, that hurts. And with these big markets, if it was, a city or a town in the middle of country, Victoria or New South Wales, you wouldn't be too concerned. But as you correctly pointed out, it's the bulk of Victoria, and Victoria contributes 25% to Australia's GDP.
Yeah, exactly right. So it's a nerve-wracking thought. If Sydney went into a similar lockdown, you look at that percentage on Australia, especially for a long term. But again, we are crawling out of it. We're getting there. It's just a case where this concept of fiscal cliff hasn't been seen yet. So
no, exactly. The can keeps getting kicked down the road, and people are working it from there. So the other thing too, which is concerning, these passenger caps. We're seeing not only economic damage, but also to from a mental health point of view, it is just absolutely disgusting. Last week, obviously, the government announced those 2 loans, the cost of living loan and the flight return loan, which it's good, but they had to provide those because they've artificially created the problem by putting caps on passenger returns. Now, when you've got hotels begging for business, and to me, some states have done a good job with the hotel quarantine, management. Some haven't. I saw a case the other day where, was it the Travelodge in Brisbane, where people are complaining about the quality of the hotel, and the police went and looked, and they actually picked up everyone and moved them. So
it surprised me.
To me, from a governance point of view, from a compliance point of view, the police definitely need to be involved in the quarantining process. like there has been in Sydney and Brisbane. But Melbourne, you can't outsource that to some security guard who was manning a nightclub door, 2 weeks prior.
Oh, yeah.
So,
Well, you look at the issue. That investigation into Daniel Andrews, the Premier, he was saying that the ADF wasn't, available to him to help, but it was. So he's lied. He's lied a few times now. So I just can't see him holding his position very long, given just what an upset and what a major stuff up it's been. And you're right. I mean, that security guard, not going to be getting paid too much, and probably not understanding the gravity of the situation on how quick these things can obviously spread and transfer. And we're seeing it play out right now. Exactly right.
Yeah.
Exactly.
And the other one to watch is the Queensland election, the state government on the 31st of October. I think that case of those newborns out of Ballina, was it? That one died because they couldn't get into Queensland. That may blow back on the Premier. You've got scenarios where Queensland is highly reliant on travel and tourism, and by maintaining those border closures. So is that going to be blowback? It's going to be interesting to see how that pans out, because we'll get a real temperature reading on what locals are thinking anyway, in how Anastasia Palaszczuk's handling all these quarantines.
Yeah, absolutely. And I mean, Brett, we'll move on from this as in terms of a bit of a market update, what's going on. But today I wanted to mainly discuss just a few concepts that we always refer to in these webinars. I've had a few people ask questions about them as well. So I thought we'd go through, firstly, just, tax residency test. What is TARP or TAP? What is non-TARP? What is the CGT rate, capital gains tax rate? What was known as the 50% discount concession, the main residence exemption, franking credits, withholding taxes. So just a few different concepts that we always sort of reference, but,
Financial Jargon 101.
Well, that's right. Just going down, I suppose, that path, just because we refer to it a fair bit, but sometimes we make assumptions that everyone understands
knows what
that is.
Yeah. And look,
exactly right.
It maps well to what we're trying to do with these sort of things, in that educate people, and if they don't understand the basics, it's hard for them to understand the concepts.
That's right. So first off, tax residency test. Now there's one obviously primary and 3 secondary. The first test being the resides test. So where we're residing permanently. The secondary tests, I'll let you delve into them if you want to just flesh them out.
Yeah, so essentially after the resides test, you have the domicile test. And just to sort of, I guess, put a framework around this, because the phraseology and the verbiage is very old-fashioned, and the reason being is the residency rules were written in 1936, and quite a lot's changed since then. So the domicile, when we say domicile, it doesn't necessarily mean where you reside. It's what your behaviours match to. So reside is pretty simple. Where do you live? I live in Dubai.
Yeah.
Bingo.
Yeah.
Domicile more refers to your behaviours and what those actions map to. Do they map to a local Emirati, a local resident, or do they map to someone who lives back in Australia? And where it gets confusing is when you have scenarios where people may have family living back in Australia, so we talk about their ties to Australia are stronger than they are locally. Then you have scenarios like we saw with that gentleman who fought the ATO and won, who was living in a service department. So the ATO really attacked to say that your residency wasn't permanent because your accommodation was temporary in nature. Luckily, the High Court saw through that, but it just gives you an idea as to, when it comes to qualifying, under the domicile test or not qualifying, you need to make sure that you have a pretty good compendium of information to substantiate you are a local, whether that's utility bills, rental agreements, all those sort of things. The fact that you picked up a 20 or a 40-foot container and moved all your furniture over, that's always a great thing as well. So, it's what do your actions map, that of a temporary move or a permanent move?
That's right. And then the next text is that 183-day test, which, I mean, residency is a really good topic right now because you've got so many expats forced back to Australia. They still might be getting paid by their foreign employer, foreign sourced income, but they're still in this grey area where they're still considered a non-resident. The ATO has provided some updated guidance, but the biggest sort of trigger event which is coming up is, obviously at the end of December, they would have been in Australia for a period greater than 183 days. And that's the biggest concern right now. A lot of non-residents or Aussies stuck back in Australia can't return back to their normal country where they ordinarily reside and where they're usually domiciled in. So they're starting to do things which actually map that of someone who would be a normal Australian tax resident. Rental leases, power bills, phone bills, internet bills, all these considerations are now coming into it, and it's going to be very interesting to see what further updated guidance the ATO provides over the coming months.
It's going to be, assimilation, isn't it? They're assimilating back into the Australian way of life as opposed to, wherever they're, previously from. To me, for those who their borders are still closed or there's no commercial flights flying into that country, it's a matter of keeping quite a large document, a library of conversations between you and your boss, or those sort of things to substantiate. Look, I would go back tomorrow if I could, but we can't. As opposed to expats who sort of have chosen Australia as the better place to ride the storm out, they still can, if they wanted to, return back to their country of residence. And if you are in that grey space, you need to make sure that you're documenting this quite laboriously, because if you don't, and then you do get that tap on the shoulder to say why you're still here, you need to have some pretty good reasons why. And the ATO was very good in the first 3 months. They said, look, we get it, people are stuck back here, and they'll come out very quickly with that guidance. Post 1 July, you could see a change in the tone of their communications. Now they're saying to companies, you need to pay PAYG, you need to do this, you need to do that. So you can see that their patience is starting to wear a bit thin, and I wouldn't be reliant on the good graces of the ATO to back you up if you haven't got a very strong argument to make.
Not at all. And I suppose that ties into the last test, which is mainly for Australian government employees, but it's a superannuation test where if we're still receiving superannuation contributions from the Australian government, then it's highly likely we'll still be considered an ordinary Australian tax resident. Pretty common for, I suppose, the military, defence force, those sort of
military, consulate
embassies,
workers,
of course.
Embassies, everything like that. So they're all the same as well. And you would know if you fall in that category because virtue by who you work for.
Yeah, absolutely. So I mean that's essentially the 4 main tax residency tests: 1 primary, 3 secondary, and I suppose the next concept that I wanted to throw out was, what is TARP? TARP or TAP?
Or TAP, it's sort of interchangeable. So essentially, it's the acronym stands for Taxable Australian Property or Taxable Australian Real Property, and the best way to sort of visualise that is house, apartment, mining lease, farm, anything that's got a bit of physicality to it, anything you can kick.
Yes.
That's what I always say to clients. If you can kick it, it's TAP.
Yep. So, I mean, TAP is treated a little bit differently when we do become a non-resident, but that's essentially what TAP is. We'll go into the change of treatment very soon. And I suppose then the other side, or the opposite, is non-TAP or non-TARP. And I suppose that's things which technically, they're not physical. Things like your shares, your managed funds, your exchange traded funds, listed investment companies, Australian real estate investment trust, those sort of things that you buy and purchase usually on a brokerage platform or exchange. They're treated as non-taxable Australian property or non-taxable Australian real property. So as I said before, they are treated very differently.
Polar opposites,
when we do. That's right, when we become a non-resident. And I suppose we might go into that just quickly because it does dovetail well into my next points was, capital gains tax rate, the discount concession, all these considerations. So firstly on TARP, Brett, what do we miss out on? What changes?
So essentially, by virtue of the name, it is taxable, which means that while you're overseas, you continue to accrue a capital gains tax liability for any appreciation of that asset while you're overseas, as opposed to non-taxable, which means that you can own that asset as a non-resident and you don't accrue a capital gains tax liability for any appreciation in the value of the assets with the ATO.
Absolutely. So, and if we're already holding assets which would normally be treated as non-TARP, so your direct shares, those sort of things, that's when we need to consider what's called deemed disposal. deemed disposal is a useful tool. We need to opt into it though. We need to look at, the total sort of capital gain on that portfolio before we leave and become a non-resident. And if we do deem disposal, it's essentially saying to the ATO, okay, as of this date that we're leaving, we're selling this portfolio on paper, in inverted commas. If there's a capital gain, we'll pay CGT, but it also means any further capital gain on that portfolio for the period that we're a non-resident is now tax exempt by the ATO. And essentially, if we continue holding it and we move back to Australia in 5 years' time, that's when our cost base for CGT will reset to that day that we return permanently. So very important there. And I suppose the next one was CGT rate. So a lot of people in a lot of different countries, they actually have different capital gains tax rates. And I suppose what's unique about Australia is that we don't. We do not have a different tax rate at all. It's just our marginal tax rates now. Yeah, no, Brett, I'll lead you into it. What are our non-resident tax rates?
Look, I think the first point of clarification is that there is no tax-free threshold. So as an Australian tax resident, you can earn a certain amount of money up to a certain level and not pay tax. As a non-resident, it starts at zero and works its way up. So essentially for the first dollar you earn up to $90,000, it's 32.5%. And then it starts stepping up, correct me if I'm wrong, from 90,000 up to 180, is it? On the threshold. And what's that 37. Go to 37? And then above that is 45. Yeah. That's so right. It's pretty steep.
It is steep. It goes up very quickly. And, if you went on the ATO's website and sort of Googled non-resident tax rates, they're not going to come up because they're actually under foreign resident tax rates. So that's how you're treated. You're treated as a foreign resident. That is what is a non-resident is, a foreign resident. And I suppose a key takeaway there is that non-resident marginal tax rates, foreign resident tax rates, higher, no tax-free threshold. And that effectively is what your capital gains tax rate is. No difference between the rates. It's just our income tax rates here in Australia. And then I suppose one thing that we miss out on now as a non-resident, which was removed back in May 2012, is the 50% CGT discount concession. So Brett, what is that concession for a normal Australian tax resident?
Yep, so essentially if you own property, shares, any asset that accrues capital gains tax, if you held that asset for longer than 12 months, you would get a 50% discount on the assessable capital gains tax. So if you held an asset and you made 100,000 Australian dollars and you held it for longer than 12 months, then as an Australian resident, you would only be taxed on half of that amount. So the marginal tax rate would be applied at $50,000. As of 8th of May 2012, as you rightly said, that was removed for non-residents. So what it means is up to that date, non-residents can access the 50% capital gains discount, but from May 2012 onwards, they do not get access to that 50% capital gains discount.
Yeah, absolutely. And I mean, if we are still in Australia past that date, you'll get the you'll get the discount concession up until you leave Australia and become a non-resident. But if you're obviously a non-resident prior to that, that's the sort of in line drawn in the sand where you might need to consider market valuations on property and those sort of things, just so it's easier for CGT purposes, calculations, those sort of things. The other item on TARP that was removed back in December 2019 was the main residence exemption. And we've been very vocal about this in the past, but again, high-level summary, Brett.
Look, people are still finding out about this, which is quite scary. I've had 2 calls in the last week of people who have either about to sell their property or have sold their property and just realised what a mistake they've made by selling as a non-resident. So long story short, as a Australian tax resident, you have what's called the main residence exemption. And best example I can provide of that is you lived in a house in Sydney for 5 years and you decided to move to Brisbane to see, what the weather's like up there and see whether you like it. You don't sell your Sydney property, you put a tenant in, you move to Brisbane, you rent. What it means is for a period of 6 years, once that property becomes income producing, you do not accrue capital gains tax. So you can sell that property as a resident in Brisbane, you can sell your Sydney property, let's say at 5 years, and not pay any capital gains tax, and then you use that money to then buy your new main residence in Brisbane if you decide to make that move. Australian expats were also able to access that rule. And it was quite a popular rule for expats because, there is no finite number on what the average time overseas is, but it would be within six years. So what it virtually means is that if you were to live in a property in Australia, move overseas, you could have sold that property overseas, and if that was sold within the 6 years of being tenanted out, then you would not pay capital gains tax. Unfortunately, now that has been removed, and not only has it been removed, but now if you were to sell that property overseas, potentially you would actually pay capital gains tax all the way back to the date you purchased it, not when you left the country.
Yeah, it's a bit ridiculous. Even the period that we live in, it really accounts for nothing, to be honest. So it's a shame that they didn't sort of draw a line in the sand. Okay, well, you're entitled to the exemption up until when you leave Australia and start renting out. They didn't sort of use the income producing asset rule with resetting the cost base, but I suppose that's the government for you. The next sort of concepts I want to discuss was franking credits, franked dividends, unfranked dividends, withholding tax. So these are really obviously a bit different from when we're investing in shares and those sort of things. But Brett, walk us through it.
Best way to think of franking credits is, I'll give you an example. I think people can sort of conceptualize the idea better when they sort of apply it to something. Let's say, for example, BHP declares $1 billion profit. They will then pay $300 million to the ATO by way of company tax, and then that would leave $700 million left over to pass on to shareholders by way of a dividend. And how much they've spent of that, they'll have a certain payout ratio, but which I won't, go too much detail on. What it virtually means is when you receive that dividend, then the ATO really can't turn around and tax you again, because that pool of money, that $1 billion, has already been taxed. So BHP has essentially paid tax on your behalf up to 30%. And you can then, as a resident or non-resident, use that franking credit, which is the tax paid on your behalf, to then offset it against any tax liabilities. So as a non-resident, we have non-resident withholding tax. And that's another term I think you're about to go into. And non-resident withholding tax is essentially a tax that is dictated based on your country of domicile and whether that country has a double taxation agreement with Australia. If it does have a DTA with Australia, then the non-resident withholding tax rate is 15%. If your country does not have a DTA with Australia, then it's 30%. However, even at the higher level, the franking credit can offset the non-resident withholding tax and essentially extinguishes that liability.
That's right. And a non-resident, this is an important one, and it's a good sign whether you've got a good accountant or a useless one. If you're receiving franking credit refunds and you're a non-resident, you need to seek advice ASAP, because you should not be receiving a franking credit refund. Even though the withholding tax rate might only be 15% and that tax credit is paid up to, say, 30%, you don't receive the difference. That's a
use it or lose it.
That's right, exactly right. So you don't get to, I suppose, have it coming back to you. Non-residents do not get franking credit refunds, only sort of within superannuation. That's a different tax environment. But that's a really good outlay of how that operates. Superannuation, SMSFs. From a non-residency point of view, superannuation as a whole, it's agnostic. It shouldn't be impacted. But SMSFs, that's completely different, isn't it?
Look, I think people would use a lot of terms in that sector interchangeably, and I think the best way to describe it is superannuation itself is legislation, not the vehicle itself, not the account.
Correct.
And under that legislation, we have all different types of superannuation accounts, from industry super funds to retail up to self-managed super funds. And when it comes to the general concept of super is agnostic to residency, whether you're a resident, non-resident. If you have super, you're taxed at, at a rate that's the same as an Australian resident. However, internally, you have different rules. So Australian super will have different rules to rest, as opposed to a retail fund, as opposed to, they'll have their own internal rules that govern and how they manage that fund.
That's right.
SMSFs is exactly right as well too. For a self-managed super fund, there are key tests to determine whether that self-managed super fund is compliant. And the reason those tests exist is because if you look at the industry funds, they have their own rules and they set those rules. So these are the rules that govern, and they provide guidance to the trustee, which is yourself, because it is self-managed. So it's almost like a roadmap as to, if you want your self-managed fund to be compliant, you have to follow those rules. And one of those biggest rules that catches a lot of expats out is central management and control. And I'll let you run through what those considerations are.
Yeah, well, I mean, generally speaking, when we have a self-managed super fund, if 50% or more of the beneficial interests, so of the balance, the investments, are held by a non-resident for tax purposes, then generally speaking, central management control is held by a non-resident, and therefore that can breach the rules around central management control. A lot of the time, a lot of individuals use this concept called rubber stamping. So they'll either look at placing a family member or setting up an enduring power of attorney, maybe even, I suppose, adding a new director to the company with inside the self-managed super fund. But again, if the ATO was to ever audit you and found relevant correspondence that you're still the individual that's pulling the strings, day-to-day operations, high-level investment instructions, those sort of things, and you're a non-resident, then you will be breaching that, I suppose, key test. And if that takes place, the way that the ATO penalises you is, one, you have 12 months to wind it up immediately. Two, you're taxed at the highest, I suppose, tax rate that we have, 47%. So that it'll tax you on the balance as well as the income in that year. So essentially you're losing half your balance immediately. You've got to wind up straight away. A good sort of way that a lot of, I suppose, expats try and address this is they'll try and do the rubber stamping, which we still don't recommend because you're just leaving too much open to risk, but they might convert it to a small APRA fund where they're actually using a different trustee, a company as a trustee, and they're not doing any decision making anymore. The investment plans being outsourced and everything like that. That's one option, but there's not too many of those small APRA fund trustees anymore in Australia. They're sort of going the way of the dodo, but that's a major consideration. It's very common also that in the event where we're able to somehow get around this central managed control rule, we need to make sure that the non-resident isn't breaching the active members test. So the active members test is if they're contributing actively, if they're rolling funds in, if they're rolling funds out, insurance premiums sometimes. When they're breaching the active members test and they're a non-resident, again, this is breaching one of the three tests, and therefore that's when it can cause a situation where we're audited and we can obviously be penalised by the ATO. So a self-managed super fund is usually, I suppose, a big no-no as a non-resident. Sometimes we already have it set up when we leave and it's hard to wind it down because of property and those considerations, and we just ask that you always seek good tax advice when that takes place, as well as if we're in the US and we have a self-managed super fund, seek some advice about how the IRS is going to treat that, foreign grantor trust rules, PFIC rules, all those sort of considerations.
Blows up in your face.
Might look at That's right. We'll probably look at doing another expat chat next week, but we might focus more on the sort of Asia Pacific region and then do another one on the EMEA region. I think that'd be a good one, just common generalities that we always see. But those are the main considerations around a self-managed super fund and those sort of tests. I've got a question that's come in also, Brett, that I want to throw your way. We probably need a bit more information, to be honest, but would participating in a share purchase plan for Australian residents while overseas be fatal to non-resident expat status?
Look, it's an interesting one. I mean, it's as you live overseas, even though you might be an Australian citizen, the tax rules are governed as if you are a foreign citizen. You know, there is no distinction when you're looking at investing in shares, whether you're an Emirati or an Australian living in Dubai, as an example. When it comes back to do you participate in a share purchase plan? Obviously, we get a lot of these all the time because all the money we manage in-house for clients. And the big distinction that we always use is you need to read the explanatory memorandum in terms of the offer and look at the offer to determine whether, as a resident of a particular country, you are able to participate.
Yeah, correct.
And if your account is set up correctly, you shouldn't be, even if you try to, you shouldn't be allowed to access it. It should actually bounce back to say, no, you're resident in Dubai, Japan, Hong Kong, Singapore, London, doesn't matter where it is. If you're using your parents' address, and that means sometimes your account is categorized as a resident, you may be able to get away with it. But that opens up a whole new kettle of fish, because now suddenly non-resident withholding tax isn't being deducted from your account. Your accounts aren't categorized correctly that it's a non-resident. So it's you know, I guess the honest answer is yes, and with many potential ramifications if you were to participate. More often than not, very few Australian expats are able to participate in these offers because there'll be a laundry list of countries that you're actually either allowed or not allowed to do it from. So it's not very good advice to participate in those sort of offers, because it could open up Pandora's box.
Absolutely. I mean, speaking of sort of Pandora's box, I mean, off the top of your head, Brett, what's probably the worst sort of tax situation you've come across from someone not receiving advice or just not actioning something and maybe sticking their head in the sand from an Australian tax return point of view when they're a non-resident?
I think the best one I had, and I think it's, to me, people can really box themselves into a corner by overthinking things. And there's a gentleman I spoke to in Qatar about 6 months ago who was 10 years behind on his tax returns. And he was frozen by fear to act, so much so that he didn't want to set foot back in the country. He had these premonitions and ideas that he was going to get arrested on arrival and all these sort of things. And, I can't imagine the amount of stress he was going through. And then I just asked him a simple question. I said, do you put your hand in your pocket every year to pay for this property? And he goes, yeah. And I said, well, they probably owe you tax credits. And it's amazing how suddenly that whole problem went away. I said, look, now you get about for penalties for non-lodgements and fines and all that sort of things. But in terms of you having to pay a large tax bill on an income and on a property, it may not be the case. So I think you can put your head in the sand and make the problem bigger than it is, when in actual fact, it's not as big a problem as you might think it is. To me, the bad ones I see are the Australian accountants who have little to no experience in dealing with expats, but they still want to maintain the relationship and work with that client. And you'll see them declaring their income, overseas income, on an Australian tax return. That's another one as well. I see that, I wouldn't say it all the time, but we see it we see it too often, I should say. And that's something that, I don't know, when was the last time they opened a tax handbook? But it's
I've come across the same issue. Someone was residing, I think, in the US for the last 4 years, and they haven't come back to Australia in 4 years, and the accountant was still declaring this US employment income. And because of our tax rates, obviously our tax rates are higher than the US's federal ones, and they were residing in Texas, so state taxes are pretty friendly there. So they were actually paying additional tax to the ATO each year, and they actually had no domicile here, no property, nothing. They were so lean, no financial ties, nothing. And I just said, I think you're going to have to go back and amend those, because you're going to be in for a nice big tax refund, because that's just not right. You need to get that updated, because you're paying tax. You're technically treated as a tax resident of two countries, which is very unusual. It wasn't a tax equalisation strategy. It's just the accountant didn't know, because it was the family accountant, and we felt obliged to use them, which is really common. I think one more blunder that I've come across was a similar scenario. The individual was using the family accountant. They were still treated as somehow a normal Australian tax resident. They were a teacher overseas. They'd been overseas for 10 years. They had a large share portfolio, every year receiving big fat franking credit refunds.
Oh no.
Going back 10 years, and I was just going, and just sort of breaking the news to them. It was had to tread carefully, because obviously I needed them to go and speak to a good accountant as well. But I just said it's highly likely all those refunds. You've got two options. You treat yourself as a tax resident, but you declare your overseas income. So either way, you're going to have to go back and amend them, or you pay back all those franking credit refunds, which was, it's more than $10,000 to $15,000 dollars per year. So if the ATO applies general interest charges on those in the reverse manner, that's a lot that has to be redone. So it's just a reflection of common blunders that can take place by sticking our head in the sand and not knowing. Just reach out, have a conversation.
And look, I think that's the biggest thing. It's in very few exceptions, it's never as bad as you maybe make it out in your head to be. And non-compliance is always worse than bad compliance. At least bad compliance is some sort of compliance, whereas non-compliance is just sticking your head in the sand and it will never go away.
That's right. And most countries have their own rules on how they govern that. I know, obviously, the US is the worst. You forget to lodge those F-bars. They've got no issues with, no issues with handing out those fines, and then you go in that streamlined method. And then sometimes the fine can be 5% of your overseas assets as well. I've spoken to a US accountant about that. And so just, you're right. Non-compliance can sometimes be worse than bad compliance, unfortunately.
Yeah, I think that's the biggest thing. 20 years ago, you jump on a plane and you could sort of wing it when it comes to managing your finances. 10 years ago, the screws started to tighten up a bit. Now with CRS, FATCA, everything, they know.
Oh yeah,
So
world's a lot smaller.
World's very small for expats, and I think that's the biggest thing. If you can take one takeaway from this at all, it's they know about you. You just don't know that.
Yeah, absolutely. Brett, why don't we wind it up there? Obviously, a big couple of months coming up. US federal election. We've got the local budget coming out, which is exciting. It's going to be interesting to see what the remainder of 2020 holds.
Definitely, and look, I think it's going to be a very noisy period, both for us and expats in general. What I'd like to implore is, we'll put in the show notes below our links to our social media pages, because we do broadcast quite frequently on those pages, especially when there are rapid changes. And also, we haven't made this call for a while. If you are enjoying the podcast, guys and girls, sincerely would love it if you give us a rating and give us a recommendation and give us some feedback. It's the noisier we get, the more proactive we can get in terms of informing and educating expats as to how they need to manage the money. If people don't know about us, they're not going to find out. And like I've seen in the last week, people are only just finding out about MRE now, whereas if they were following us, for a while, they would have, known that, these things coming up and prepare in advance. So, any help we can ask of our listeners and watchers, we'd be greatly appreciated. Certainly subscribing on the YouTube channel, giving us a thumbs up on the podcast, giving us a review, subscribing to that as well. All these little things, for someone it might take 3 seconds, but for us, the weight of numbers will help us get a broader audience and just help us get the information out there.
Absolutely. And I mean, feel free to send in your questions if there's anything you want us to delve into more or pull apart. That's why we do it, just so it's more of an education session covering off topics which matter. So if there's anything that you've got a burning question, send it through or drop it on, I suppose, the show notes or the comments underneath the podcast episodes, and we'll pull it apart on the next episode.
Fantastic, guys. Well, mate, I'll let you go on to finishing up your day. We'll start the day off here and talk to you next week on the next episode.
No worries, Brett. Have a good day, mate. Speak soon.
Cheers. Thanks, mate. Take care.
Cheers, mate. Bye.
Bye.